This morning, we've announced our half-year results to the city. Firstly, a quick rundown of the key financials. With debt reduction remaining our number one priority, the disposals during 2018 were the main driver of the reduction in our adjusted earnings per share. In spite of this, the interim dividend is unchanged. Now, we're operating in a very challenging UK retail market, with traditional high street fashion and department stores under pressure. Whilst leasing volumes have been lower during the period, our lettings at UK flagship destinations have delivered a year-on-year reduction in passing rent of just 1%. I think that's a really strong result in the current environment. It's important to understand that we're not seeing the same trends across all retailer segments. Whilst we saw reductions versus previous passing rent with regards to high street fashion, the picture was much stronger for non-fashion. And that's a trend we expect to continue going forward. Now, back to our main strategic priority of reducing debt and further strengthening our balance sheet. Despite thin investment markets, we are seeing interest in our high-quality assets, and we remain committed to more than £500 million of disposals in 2019. I'm pleased to announce this morning that we've exchanged contracts for the sale of a 75% stake in Italy D'Ur, our flagship centre in Paris, and the forward sale of 75% of the Italic extension. We also raised £33 million from retail park sales in the first half, and we're committed to exiting retail parks over the medium term. Together with the Italy D'Ur transaction, this means that we've already achieved over 90% of our 2019 disposal target. Across our portfolio, we are continuing to actively manage the mix to winning categories. 92% of new UK flagship leasing was to non-fashion brands, where we see the potential for further growth for rents. We've also continued to introduce independent, innovative brands and concepts on both permanent and shorter-term leases, with this more agile letting helping us maintain a vibrant mix in our centres. Now, while the market in the UK is tough, we've seen a stronger performance in France and Ireland. In France, occupancy and footfall remained strong, and we enjoyed another period of good leasing performance. Work has continued on our major extension of Les Trois Fontaines in Paris, and earlier this year we revised the scheme to incorporate more leisure and an improved F&B offer, with the new food hall that's due to open in the spring of 2020 already fully let. Our flagship destinations in Ireland have the highest occupancy in the portfolio, alongside increased footfall and good leasing to new local brands, F&B heavyweights and Irish retailers. Premium outlets, now at 27% of the portfolio, is our second largest group of assets after UK flagships, have delivered another exceptional set of numbers. We saw continued uplift in brand sales, rents and accelerated footfall growth across both value retail and via outlets. As the first listed property company globally to introduce a net positive target in 2017, we continued to reduce our environmental impact in the first half. With significant reductions in energy usage and carbon emissions, we're working hard to reach our industry target to be net positive for carbon, resource use, water and waste by 2030. Now, despite the challenges in some of our markets, we will not let this dampen our environmental and social responsibilities. Over the longer term, our city quarters concept will see the business moving from pure play retail to retail and beyond. This represents a fundamental shift in our thinking. We can use the 100 acres of land we have around our flagship destinations to move beyond retail and create vibrant, attractive neighbourhoods to further support our flagship destinations. To give you a flavour, Martineau Galleries in Birmingham, where we have submitted a master plan, will deliver up to 1,300 homes, workspace, new shops, cafes, restaurants, a new hotel and public square. And we've also just submitted a revised application for the Goods Yard in Shoreditch, London. And while we're thinking about the long-term and future ambitions for the business, we're certainly not complacent nor unrealistic about the present. We will continue to manage the business hard, facing up to the current environment, to ensure our destinations are where people and brands want to be, both now and in the future.